专业名家汇集，市场大势解析，投资痛点事宜，时下热点直击。欢迎收看房东网名家讲坛。
名家讲坛，真知灼见。大家好，这里是58Home 房东网名家讲坛。So you brought up another very good point, talking about break even. This is a very interesting term that we would like to have from your extensive experience in the past. That there are two type of wording or interpretation on the break even. In your mind, how would you interpret this break even term there?
For me, break even is not losing money. I'm just not losing money on a day-to-day basis. I'm not making money, but I'm not losing money. And when I look at those 4 ways that I talked about to make money in real estate, I may have a negative cash flow, but my principal recapture is greater than my negative cash flow. So let's say I have a property and I have to put in $100 a month, but my principal recapture is $150. So my mortgage is actually, that $100 I'm actually getting back. I'm getting it back in the principal recapture of that mortgage. For me, that's still break even. In fact, I'm still winning, right? I may not be cash flowing, but I'm taking advantage of the market growing. I'm taking advantage maybe of the value add that I'm going to have in the future. And I'm taking advantage of my mortgage being paid down. So for me, I'm actually winning, even though I have a negative cash flow. So I think you have to look at the whole big picture and you have to say, how long can I support this negative cash flow? Because if you can support it, let's say I have a negative cash flow, $200. Okay. But I have $3,000 in the bank. I can support that for a year without it impacting me greatly. So I look at all of my resources, I look at my portfolio, and I say, how long can I support this negative cash flow? Because I know I'm winning in the other ways of real estate. And it's like, when will I run out of money to pay this and to support this? And during that time, I look at my mortgage structure. Can I refinance this? Can I extend the amortization, increase my cash flow that way? Can I do something by leveraging my property, getting access to more money, and do a private lending? Now my private lending is taking care of the negative cash flow. So in the end, I'm actually more than breaking even. When you're breaking even, like for me, that means you have zero return. You're at zero. You still have the asset, but you're at zero. And if you can afford to wait out that time, then you're still doing okay. Right? So that's breaking even for me. And it's not about not cash flowing. Because when you look at the whole big picture, you have to make decisions and work with professionals that'll help you determine how else can I make money in this portfolio. You said something really important a minute ago about passive income. People making money in their sleep. Right? And the goal, I think, of any real estate investor is, or probably should be, is to, how do I leverage my portfolio so that it makes money for me? It makes money in my sleep. Because, I have a pretty large portfolio, but the thing that I want more than anything is to be able to leverage my net worth, lend it out, do something with it, invest in something passively so that my money works even when I don't. And most passive investors have at least 7 to 9 streams of income. Millionaires have more than one stream of income. It's not just their work. It's not just their real estate cash flow. It's typically something else. And they typically have anywhere from 7 to 9 different streams of income, minimum, to become a millionaire.
So leveraging could be one of the very, very key wordings there, right?
Yeah, exactly.
If we analyze this break even, can we analyze that in 3 different angles? Angle A is that on a daily basis, right? On an everyday basis, we can say whatever the cash flow or break even, make sure that I'm not losing that, as I said, right? Second angle B, that could be in a certain period of time, right? as long as I break even, right? I may, as you said, I may lose here a little bit, but I gain in a certain period of time. After I sell the house, for example, or after renovation, whatever those, I rent it out. That's the angle B. Angle C, that more from the broader economic principle or concept there, that when we also sometimes talk about the opportunity cost, right?
Right.
If we put an opportunity cost into the consideration, would you think that could be more meaningful to us when we analyze the break-even term there?
Yeah, I do actually, because opportunity costs, I mean, if my money's tied up,
right,
and I can't get at it, and other opportunities are coming along that are greater than what I'm currently doing.
Exactly.
It impacts me.
Right.
It impacts my potential. Right? It may not actually impact me financially, but there's a perceived impact. Right? Of I could have done something better, or I could have chosen something that would have given me a better opportunity.
Right.
I think sometimes we get caught up in all that, and I think it's important to just look at the health of your portfolio today and in the future. Don't worry about what you're missing out on, because it's not relevant to what you're having happen right now. We have to survive this time, right? And sure, there's plenty of opportunities that are better. And that's that opportunity cost thing, right? I lend my money to somebody, I'm only making 12%, but there's something else over here where I can make 20%. I've lost 8%. That's the opportunity cost, right? Or I look at it from a different perspective and I say, this is a really safe and reliable investment that I'm in at 12% that's helping me carry the rest of my portfolio.
Exactly.
Am I really losing?
Right.
Probably not. I think part of it is a mindset, is the mindset of scarcity versus abundance.
Right.
Right? If you're in an abundant mindset, you're going to look at everything as a whole. If you're going to look at a scarcity mindset, you're going to look at things in isolation. So I think it's important you look at it as a whole, and you look at your whole portfolio and you make sure that it's aligned to your goals.
Yeah.
It's still moving you forward. Right. If you're losing and you're losing more money than you can afford to lose, it's time to look at the whole thing and make adjustments where necessary. Maybe it's not your underperforming property that you sell. Maybe it's the high-performing property that you sell, because now you have all that equity out and it's more saleable. Right? Because nobody wants an underperforming property. You may want to sell your high-performing property to access all those monies so that you don't miss those opportunities.
So you used a pretty good word, the mindset. Let's talk about that in our daily property investment there, how can we manage and control break-even there? Right.
So I think it's not even just managing and controlling is simple math. It's just math. You cannot force the numbers. The numbers are the numbers. If you can say, oh, but if I did this, if you do this, are you making that money? No. Okay. So don't force it. I see a lot of investors in my coaching career where they say, oh, but if I change this, or I got this zoning and I did this and I did that, or if I kick out a tenant and I put in a new tenant that's paying market rent and I tell them they have to go because I'm going to do a renovation, they're gone. I always say, how long is it going to take you to recover that money? Right? So now your property's vacant because you've decided you're gonna evict this tenant, you're gonna renovate it, and you're gonna make more market rent. But it costs you $25,000 to do that renovation up front. Okay, and your unit is vacant for 4 months. So now you're up to $35,000. Right? Yeah. You've increased your rent. Well, how long is it going to take you to recover that money?
With all
70 months. 70 months. When you start adding it up and you get that increased rent, it's actually going to take you more than 5 years to recover that money. So was it worth it? You have to look at it from a leverage perspective, break even by what you can leverage already. Right? I think it's important to look at your your whole thing. Where can I get some money out so that I can do something else? Do some private lending, do a little bit of passive stuff.
Right.
Now's the time to actually do that, to be honest, because people are having difficulty finding cash flowing properties. But if you've got equity in your portfolio, now's the time to maybe leverage it a little bit and adjust. Do something that's less risk, but passive. Maybe you want to do a mortgage lend. Maybe you want to lend a little bit of money. If you're making 5% on your money, on $100,000, that's $5,000 a year. Your $200 negative cash flow is now covered by your $5,000 a year that you're making, right? So I think it's important that you just understand the math, because it is just straight up math. 1 + 1 is 2. You know, so you have to look at your whole portfolio mathematically. And if you don't know how to do that, then speak to an expert that does, you know. And there are a lot of investor-focused mortgage brokers out there that can help you. And it's important that you speak to somebody that knows how to help you calculate that, right? Because it is difficult. It's not... It isn't 1 + 1 = 2. It is, but it's not as easy as 1 + 1 = 2. Right? So you need professionals to look at the whole thing for you and to help you understand, am I winning?
So it's not that simple, that straightforward 1 + 1 = 2. It's multi-factors. What elements, factors should be in price included in all those, right? In order to get this 1 + 1 = 2.
Exactly, because you're getting a little bit. It is the challenging part. It's the part that people miss on. They miss on thinking that cash flow is the only thing. It's not the only thing, but if it is affecting you personally and you can't afford the cash flow, the negative cash flow, then you cannot leverage your property anymore because you don't qualify, then you need to sell it.
Yeah. That's why sometimes we were joking that tomorrow is pretty good. It's prosperous, but today it's kind of suffering. But you have to survive from today in order to get to tomorrow.
Exactly. So you do have to survive, and that's where it's really important is to understand how long can you survive. Don't wait till the last minute, because now you'll lose more money because you're desperate. Right? So you have to plan. And I know on one of my properties, it was a few years ago, I knew that I had to sell by September or October, or I was going to start losing money on this property. So it was a property I had a few years ago, right after COVID. I sat down with a financial analyst and said, when will I start losing money? Because I was breaking even. And I said, how long do I have until I run out of money? And he said, you need to get this one out of your portfolio by December, by the fall or December. So I put it on the market in April. Because I thought, I'm not going to wait till September to sell this.
So you were well prepared.
I was well prepared because I had people that were looking at the numbers and making sure that I wasn't going to be in a situation where I had to discount the value of what I was selling. So I put it on the market early, and it was in a hot market. It was in a good time. And I said, as soon as I got the news that I had about 8 months before I was going to be at break even and then start losing money, I said, I'm going to sell it now. And I just made the decision. I staged the house. I had it was sold in 5 days in a hot market, and it sold at $450 over the price because it was competitive. I didn't want to sell at the time. I didn't want to, but I knew that the market was getting competitive. And I thought, well, let's take advantage of what's going on right now. I hurried myself up, got everything done within a week. That was hard. Got everything done within a week, got it listed, and it was sold. And 4 weeks later, I was moving, you know? So you have to know and work with people and don't get caught too late.
That sounds like that you took a pretty smart strategy there, right?
Selling
your house.
I did. I sold my own primary residence because I had the opportunity to sell it capital gains free, and said,
Right.
I'm just going to sell this.
Tax-wise, right?
Yeah, I from a tax perspective, it was a better play to sell my primary.
Right.
So I sold my primary. I had another house to go to because I have a vacation property that I live in as well, part-time. So I just said, I'm going to sell this one and I'm going to get all my money back, and that's going to carry me. And it did. It carried me for several years. It still carries me. And I think it was important to just, because your home is also in your portfolio.
Right.
And it is typically the quickest and easiest one to sell. Because an investor or a new homeowner isn't looking at your tenants and thinking, oh, I'm going to have a headache with tenants.
You don't have that headache.
Exactly.
That burden there.
Yeah. So if you're running into a situation where you may be running out of money, maybe it's better just to sell one of your your primary residence, move into a vacant tenanted or a vacant property.
Right. And also that from tax perspective, that actually could be more attractive there. Right?
Sure. For me, I made way more money because I didn't pay tax on it.
Right. Yeah. So actually you mentioned that another term that actually relevant to what we're talking about right now, it is, and also mentioned a part of that before, the LTV, the loan to value ratio.
Right.
Would you elaborate a little bit?
Sure.
Yes.
I like to think of loan to value as a house. Okay. So let's look at a house, right? We've got a house that's shaped like this. At the top of the house is your equity. That's the attic. Okay. You've got your 80% is the house. 20% is in the attic. You can get a mortgage. If it's your primary residence, you can go 95% loan to value because the bank will let you only put 5% down, which a lot of people don't know. If it's your primary residence, it's not just for your first time. You can put 5% down if this is your primary residence, which means your loan to value is going to be 95%, right? If it's an income property, it's going to be 80% because they're going to expect you to put 20% down. That's what I call equity in the attic. It's the equity that you have up there. It's your down payment. It's in there. That's yours. You can't access it conventionally with an A lender. They'll only let you go up to 80%. A B lender or a C lender will let you go all the way up to 100, sometimes even more, depending on what you're doing. But typically, that equity in the attic can't be touched. Your loan to value is basically your house rules. Let's call them the house rules, the 80%. When you get to the mortgage structure, mortgages are broken into two parts. There's the 15% minimum in a mortgage and 65% maximum in a line of credit. So when you add your 15 and your 65, you get 80%, right? So imagine you own your house. It's $500,000 and you want to access that. A lot of people think they have to get a mortgage for 80% loan to value, go all the way up. But what they can do, in fact, is access 15% of it. So we're going to do 15% of that $400,000, the 80% loan to value. We're going to get 15% of it, and we're going to go 65% on top of that. So my mortgage is in the basement. My 65% is my line of credit. So now I'm all the way up to 80%, right? So I can put a blended product on it. I can do 15% in a mortgage, 65% in a line of credit. The benefit of doing that, now this is where this is the ninja move when it comes to mortgages, is the benefit of doing that is every time you pay off your line of credit, it's still available to you. So if you do a blended product at 85% loan to value, your principal recapture or whatever you're paying back is available to you. And they will allow you up to 65% loan to value in a revolving credit, right? So if you have this revolving credit, I qualified today for it, but I quit my job or retire 5 years from now, I still have that mortgage structure. I still am able to access that 65%, which is amazing because and you should put this on every property you own. you should have, in my opinion, you should have a collateral mortgage, it's called, with a line of credit. So there's all sorts of different products. CIBC has the HELOC, TD has TD Flex Line, Scotia has the STEP product. And what it is it's a combination line of credit, combination mortgage. As you pay down, it's available to you. So
for those revolving parts.
It's the revolving part's available. So if it was just, you know, 100,000 I pay $1 on my mortgage. I owe 99, but that $1's still available. So I can go back and borrow against it. And what that does strategically is it allows you to leverage your property without qualifying. Because you've already qualified. You qualify once, you set it and forget it. And what you can do in the future, say you still have your job. Okay, let's say I'm 60, I'm just getting ready to retire at 65. Before I retire, I go and I get my homes reappraised and I increase my leverage, my loan to value.
Through those appraisals.
Through those appraisals. I don't have to take a bigger mortgage. I don't have to get a bigger mortgage. I just increase that 65% portion that I'm allowed to increase, right? So it's really important that people understand there's two parts to it. They'll never let you go higher than 65%. This is why I want to get my loan to value to 65, right? Because when my loan to value goes to 65, I get better banking, right? They like me more. And as I pay it down, I still have that 65 available, right? That's a really good goal to have. In the beginning, you want to go up to 80% because you want to grab that extra 15% that you wouldn't normally have. But as you're getting closer to retirement or your mortgages are being paid off, try to get lower. Try to get lower so that you can just get better banking. You can always go get that 15% as a mortgage and go up to 80%, but they're never going to give you 100. Right? They're never going to give you 100. So access as much as you can with the right products. And I've said this 100 times. Your mortgage broker is your friend. They help you get the right product to help you move forward.
So you did mention some very, very good concept or terms there. 65%, 80%, and also revolving portion. Those investors might want to prioritize, or leveraging that, Those to get the better investment strategy there,
I think what people miss quite often is they don't know. This is what we were talking about the over renovating or the overvaluing of a property. They don't understand that you can only get up to the 80%, but you have to qualify for it. It doesn't matter if you have all that equity. If you don't qualify for that 80% loan to value, nobody's going to give it to you. So you may get it from a B or a C lender, but quite often you have to qualify for it. And if you can qualify at the A lender rate, we all need B and C lenders to build our portfolio. But once it's getting built and it's moving forward, you want to be in the A lender stream because you're going to cash flow more. Because they give you better stuff. They give you better mortgages. They give you better products. You're not getting that revolving credit with a B lender. You're not getting it with a C lender. It's with the big banks. So, and that's where you want to be in the end because that's how you can start generating passive income. You can use that equity that you have access to, and you can, that's the fifth way to win in real estate, really, is leveraging that property, leveraging those funds that you have available, and making more money on that money.
So are you kind of commenting that actually probably we can take the A lender as the primary resources, a primary taken there, however that leave the flexibility for the B lenders or even C lenders so that it can help you, give you the flexibility to leverage to finalize your overall portfolio there.
So I call that capital stacking. So you have your A lenders as as part of your capital stacking, and then you have your B lenders. Sometimes you have a VTB in there. Sometimes you have a private lender. Like if you stack how much money you can get based on what their criteria is. Right.
Since you talk about VTB, we just bring up this question up in front here. This VTB stands for vendor take back financing there. What's your understanding? What are the elements behind that we should be alert or be aware of?
The great thing about a vendor take back is the transfer of ownership happens immediately. So in a rent to own, for example, ownership happens later. In a vendor take back, ownership happens immediately. So you and I agree that I'm going to buy your farm. Okay, you have a farm and you say, and this is how financing used to happen. Historically, people didn't go to banks. They went to the seller, and the seller held the mortgage for them, and they bought the farm or they bought the land. And you would pay the farmer or the landowner a mortgage rate every single month. And and then you would own the house. You would own the house initially with a deposit, with a down payment. Transfer of title happens, and then you pay the seller a mortgage. That's vendor take-back financing. I have a whole bunch of those right now in my portfolio, and the benefit is, particularly on things that are hard to finance, things that lenders don't want to lend on, like raw land. You know, you're buying raw land. Well, they don't want to give you on raw land. I just overpaid for a property in Windsor. People say, why would you pay twice as much for this property? I paid twice as much because it's a single family home in the middle of the country. It's on farmland. It's only worth $750,000, but I paid $1.5 million for it. The seller gave me $650,000 in a vendor take back mortgage, right? There's no way I would qualify for this property because we overpaid. You know, why would I overpay? Because I'm tearing down the house. I'm going to put a 50-unit apartment building there, but no A lender, B lender, C lender is going to give me a mortgage on something I'm tearing down. Because for some reason they like to have their assets intact, right? They want to make sure that whatever they're financing, it's worth something and it's not just dirt. So we went to the seller and said, hey, can you finance this for us? We'll give you $850,000, which was more than what it was worth. And they're holding the $650,000 because we know we can't go get that money somewhere else. We can go get it from equity partners, and that's what we're doing. We're going to exit this lender in the future. But for the transaction, we asked for vendor take-back financing for 1 year. I've done it with cottages because in cottage country, when you buy a vacation property, if it was a short-term rental, it's difficult to get financing on it if they didn't show all their income. So the bookkeeping of the seller is really important. So sometimes you can get your seller who didn't do accurate bookkeeping to do the financing for you. It's a really good strategy to give them more money. So I bought my vacation property for $330,000. They wanted $350,000. Okay. So what I agreed to was I'll buy it for $330,000, but I'm going to pay you $15,000 in interest for the year. And I still owe you $330,000. So that gets them to $345,000. It's closer to what their goal is. They held it for an extra year, so now they're up to $360,000. Then they held it in the third year. They're up to $385,000. We agreed at $330,000. They didn't need all the money up front, so it's really important to find out why are they selling this property and what do they need. If you can satisfy what they need, you can negotiate vendor take-back financing. Because you have to service them first, right?
So actually, there are two very important concept or element they just mentioned about there. Well, A is that to some extent, this is the seller was helping the buyer to get the transaction there, right? Number one. But number two, then more importantly, that you know the real estate market, you know the trending, you know why I'm willing to pay you some interest there up in front in order to let you to hold it, right? And then we can just make sure that I can potentially gain some profits in year 2, year 3 there.
Exactly. What was really neat about this transaction is We gave them a down payment. We gave them 35% down, $115,000. So they really only held, I think it was $215,000 in a mortgage. So we gave them a deposit to start with. What was really important is because it was an income property, the seller gets to defer their capital gains up to 5 years. So that money, that $330,000, they would have normally had to pay tax on 50% of it because they owned it outright. And because it was a severed parcel of land, they were going to pay big tax on that money. So what this allowed them to do was me paying them this interest allowed them to pay their tax with that money. They ended up with more money because they were able to defer the capital gain. And I paid them the interest, and they just put that in the, against their taxes, which really helped them.
So to some extent, it could be a win-win.
It should be win-win.
Situation there, right?
Yeah, it should actually be win-win. I'm helping the seller's helping me. And this is the best is when it is win-win. It should not be a win-lose situation. The best VTBs I have is when the party that's selling is actually coming out ahead, right? Because it doesn't hurt me financially to move them ahead. It moves me forward as well because they're difficult properties to finance. I want the property, but it's difficult to get conventional financing because I've either overpaid for it because I'm going to do a land development, or I've paid the right price for it, but nobody wants to finance it because it's a vacation property or because I don't qualify at the moment. If I don't qualify at the moment, I can do a vendor take back. And when I do qualify with the bank, now I can exit my seller and I qualify. So it's a good strategy and it is win-win.
Very good, very good. Actually, we mentioned that partially before, but we would like to get a better understanding on the private lending. Because that's also related to the topic we're just talking about right now. For those private lending that some of the investors are kind of hesitating because they are much more familiar and more comfortable to some extent get A lenders, right?
Yeah, or be with properties.
Yeah, but for those private lending, what's your comment on that?
Well, I have hundreds of private lenders. I probably have 350 to 400 private lenders that help me with my portfolio. I know the reason why they private lend is it generates cash flow for them. So because they're using capital that is either borrowed capital or existing capital that they have in their portfolio, and they're able to generate cash flow and a monthly payment for themselves without having to buy a property. So properties may have a higher ROI overall, but they have inherent risks, with tenants, toilets, trades, all that sort of thing. Whereas private lending is a very passive way to make money in real estate. And if you do it properly, I'm not a big believer in lending your money without documentation. So this is the mistake people make is it's like, oh, I'm just lending my brother $50,000, he'll pay me back. Well, you need to have it properly documented. You should do it in a mortgage. You should have a lawyer document that for you.
To avoid potential risks.
Well, to avoid potential risks. And the biggest risk is actually that something happens to the borrower. So if something happens to the borrower and you don't have a claim on that property, how are you getting your money back? Private lending, I think, is an important part of anybody's portfolio because it allows you to grow your portfolio passively, especially if you have, I call registered funds sleeping giants. So if you've got an RSP or a TFSA or you've got registered funds and they're sitting there with your financial advisor making a big 3-4%, because when you figure out what you put in and what was last year and what was made, and after they get all their fees and the ups and downs in the market, you're actually not making that much. I challenge everybody to go look at their statements from last year and this year and see how much they actually made. They probably, in a really, really good year, they're maybe making 6 or 7% in a good year.
Some year, for example, last year, they may be losing
lose money, sure. Sure, that happens, right? But if you're private lending, registered funds, or cash in mortgages, for example, or in private equity, where you become a limited partner in real estate or you become a mortgage lender in real estate, you now have your money secured, right? There's two types of private lending. There's being a loaner and being an owner. So there's two different types. The loaner is somebody that holds a mortgage for you, and they're your private lender in a loaning position, and they have a mortgage against your property. Being an owner in the private lender situation, and this gets confusing for some people, is you've got the loaner, which is mortgages. You've got the owner, which is private equity. So now I lend you $50,000 and I come into your project and I'm your partner, but I'm a limited partner. You're the general partner, I'm the limited partner. I can now put my money in your investment vehicle, in what you're developing, and I can make money on that. The difference is there's a higher risk. In the equity project, I make money if you make money, because I'm an owner, just like you. We share in the ownership of that, and we make money together. In the loaning capacity, I make money whether you make money or not. Because it's stated in our terms of agreement that I'm going to have a specific rate of return. So private lending is less risky, I'm going to say, if you are very aware of your loan to value. You don't want to go too high up in loan to value. You've got to stay at that 80 to 90%, never more than that. In this market, I would say 80%. Don't go above 80% if you don't want to lose a dime, right? Because the market's fluctuating. You don't want to lend 100% when things are going down.
So you need to be fully aware of the preconditions, whatever those, before you actually proceed.
100%. And read the documentation and read the appraisals. Like, what does the appraisal say? Is this the as-is price or is it the future price? You don't want to... What happens if the project stalls and you're lending on a future value, but the project stalls and this person runs out of money? Well, now you're at risk, right? So it's really important that you read your documentation. Remember, there's loaning and owning, and they're different, right? Loaning is a lower rate of return. It's less risky. Owning, higher rate of return, more risky.
Exactly.
So it's, you know what they say, no risk, no return, right?
Exactly. So you have to balance that, which side that you're working on those, right?
Yeah, and never lend something that you can't afford to lose.
Right. And you mentioned about NOI, that net operating income. That actually comes to another term, that for the cap rate, which the NOI is only part of that, the concept there. That's the cap rate. That's typically, we say, the NOI divided by the current market value of the properties there. For this cap rate, that recently we have some very hot discussions on those. That what are the key concepts behind that? Yeah,
so the funny thing about cap rate is it's a number or a calculation that was created to value properties that didn't have comparables. So commercial, industrial, multifamily, that sort of thing. It was a calculation that was created based on the economic value of a property, which was directly related to the net operating income. Okay, I'm a bigger believer, less believer in cap rate, bigger believer in net operating income, because I can control that. Okay, cap rate is more related on the municipality and the city, and it's related to other things. I want to manage what I can manage. So what I look at is the net operating income, because there's two ways to increase your net operating income. One of them is to increase your rents. If you can increase your revenue coming into that building, your NOI goes up. If you can decrease your expenses, your NOI goes up. So there's ways that you can control the economic value of your building by doing the right things.
In different directions.
In different directions, sure, and you're in better control. So rather than what the market or the industry experts say, I want cash flow. So I'm going to focus on my NOI. I'm going to focus on the net operating income. How do I make more money? I spend less. So I'm going to get a better mortgage product. I'm going to put in LED lighting. I'm going to put in vinyl or efficient windows.
Right.
If I'm going to do my renovation, I'm going to make my building more efficient.
Right.
I'm going to have it so it doesn't cost me as much for heating. Right. I'm going to get rid of electric baseboards and put in a boiler system. I'm going to do those things that make my building more efficient, make it less costly, and then I'm going to drive revenue. So as well as, right? So I'm going to increase my rents when I'm supposed to increase my rents and do my annual increases. When somebody moves out, I'm going to give a value add. I'm not going to force them out. I'm going to do natural attrition. Somebody moves out, I'm going to increase the value of that unit and I'm going to rent it for more. Right? So now my NOI goes up. Another way is maybe I add coin laundry. Maybe I add parking. Maybe I do different things to my building that are going to bring in a revenue stream. Right? It's got to bring in a good revenue stream. And I'm going to decrease my expenses. That, to me, increasing your NOI increases the economic value of your apartment building. Now, yes, they take the cap rate into part of that calculation.
Right.
And they say, this is your revenue, this is the cap rate, we multiply it by this, and it's this. Manage what you can manage. Because that piece you can't manage. It's an industry standard. It's a community standard. It depends on the market that you're in. So if you just focus on NOI, you're gonna come out way further ahead than focusing on buying. Oh, I'm gonna go buy here because the cap rate's this. Like I believe in managing what you can manage.
Exactly.
专业名家汇集，市场大势解析，投资痛点事宜，时下热点直击。欢迎收看房东网名家讲坛。